In this episode, I sit down with Arjun, CEO and founder of Doola.
So our thesis was, how can we help founders not just start a company and give them a checklist of things to do where they feel like they've been thrown to the wolves?
Yep.
Why can't it all be in one place?
He's raised $13 million to date, is at an 8-figure run rate with over 60 team members globally, 10,000 customers, and generating profitable cash flow.
And we call it a business in a box for e-commerce.
Doola is a business in a box for e-commerce where people on Shopify or Amazon can start their LLC with all required paperwork and scale it with necessary bookkeeping and analytics. I hope you enjoy the show.
Arjun Mahadevan, everyone. Arjun, welcome, man.
Thanks for having me on, man. I'm excited to be here.
Yeah, dude. So, okay, in this show, we're not going to be spending much time going into the background of our impressive guest. You can find a lot of that material online. So we're kind of going to jump right into Arjun, your business, kind of the behind the scenes of it. For starters, share a little bit with us. Where were you actually born and raised?
I was born in, and a lot of people don't believe this, I was born in London.
Okay.
I grew up in Cardiff, Wales. So
sick. All
people
right.
say you don't have the accent. I used to have the accent, but when I was 6, my family immigrated from England to Boston.
Okay.
So I say you win some, you lose some. I don't have a British accent, but I didn't get the Boston accent.
There you go. And I saw that you went to school at UPenn Wharton and then started Doola in 2020. Is that right?
Correct.
So maybe start us off and talk us through what is Doola and why did you actually start it back in 2020?
Most entrepreneurs, let's say you're starting a Shopify business or selling on Amazon, you first go to Google to look up how to start a business and you find 5 pieces of conflicting, quote, migraine-inducing information. That's a direct line from our customers. If you figure that out, okay, I should start an LLC, I need an EIN, a bank account. You then go to a state website, looks like it was created in the AOL era. Yeah. It's archaic, hard to use. Then you get a bank account, but then you've just started there. Your goal is to get you your first sale. Then there's this whole world of things like bookkeeping and accounting and sales tax registrations and reseller certificates and Form 5472 filings if you're a non-US disregarded single member LLC. All of that is required and critical for your business, but it's not growing the business. So our thesis was, how can we help founders not just start a company and give them a checklist of things to do where they feel like they've been thrown to the wolves?
Yep.
Instead, why can't it all be in one place with a Staples easy button type solution? And we call it a business in a box for e-commerce, where someone on Shopify or Amazon can start an LLC in all 50 states, will do their initial sales tax registration, help them get a reseller certificate, and then in-house with human bookkeepers and CPAs. And I say human because we believe AI is great, but people still want some human touch.
Yep.
We'll actually do your books, file your business taxes, and we'll do your e-commerce analytics.
Yep.
There's few things people check every day in life, maybe TikTok, maybe Instagram. You check your data dashboard every single day. So we want to go from something which is just you start your business to you wake up every day and say, let me check Doola to not just start my business, but level it up and scale it too.
I see. And did this stem from like you wanted to start a business and you were like, what do I actually do? And then you're like, wait, why is this so difficult?
We got into Y Combinator.
Okay.
The company failed actually halfway through the batch. We had to shut the company down. It was a video messaging app, kind of like Instagram stories, but for work. So let's say someone's in Singapore and I'm in the US, that's, I believe, 12 plus hours time zone difference. Instead of a live call, what if you could post a story instead? Sounds cool, sounds sexy, it's a consumer concept applied to work. The shocker is, a lot of people hate recording themselves on video. A lot of people do, and then they want real-time communication. So we shut that down. And when thinking about what to build next, the only thing which I actually knew being, we're going to have to pay 30 grand in legal fees because that's what we paid the first time. International company, IP flip, lawyers charge $1,000 by the hour. I didn't know that. I was sending emails for stupid things to them. Accounting, bookkeeping, registered agent, payroll. So the idea was, wait, why do you have to pay so much money to actually not just start, but initialize a company? And then realize you don't have to pay an hourly fee for something which can be automated with technology and bundle things together. I think ultimately businesses are either unbundling or bundling. We very much take the bundling approach.
Yep. And the focus, specifically, you're leaning into the e-com side. Like you guys want to target e-com businesses. Yeah.
Correct. Although the solution does work for non-e-commerce businesses, whole entire separate segment on niching down and the importance of finding one niche, even if you want to go after many. But what we now say as a team is we can serve many people mediocrely or select groups spectacularly. So we're building the business in a box for e-commerce, but technically the box works if you're a marketing consultant or a SaaS engineer in Dubai building a side hustle SaaS business.
Yeah. And I'm sure, so obviously it's been, almost 5 years now. The business has iterated, developed, and so on. As far as your objective and kind of goal with the business, has that stayed pretty consistent or has that changed over time? And kind of where is it at today? Like, what is your North Star that you're going towards?
Our vision is we want to reach 1 billion founders. And I say reach because working backwards, 8 billion people, 4 billion people have internet connection. The bar is coming down to actually create a business, an online business.
Yeah.
So we want to reach 1 billion people. Now, will billion people actually start a US LLC or scale a business with us? Maybe not. But through content, we can reach that many people. And ultimately, that is our goal. If we can help them learn how to actually start a business or scale it, make that dream idea become reality, huge way to have an impact. Now, in terms of more tactical, what our goals are, we're a venture-backed company. Our goal is to get to 100 million plus in revenue, high quality revenue, and we can get into what I think about revenue lines, but recurring revenue streams and what I call occurring revenue streams. And overall, our goal is to get to 100 million in revenue. We think we can do it, and there's a huge opportunity now. For context, we're at a 10-figure or 8-figure run rate right now. We just passed 10 million.
Nice.
Cash flow profitable. So we believe, hey, I think as a team, if we can get to 1, you can get to 2. If you can get to 2, you can get to 4. If you can get to 4, you can get to 8. It's more about the systems and processes.
Yeah. So okay, let's get into the revenue side then a little bit more. What you mentioned two different ways to measure it. So expand on that a little bit for me.
Our core product lines, these are the recurring offerings, are a starter plan, which is a registered agent and a virtual mailing address.
Okay.
So you've started a business. We actually do formation for free. It's a one-time thing. We do it for free.
Okay.
Which renews every year for $297 is your registered agent, a virtual mailing address, and support to the team.
Okay.
So that renews at $297. That is true recurring revenue.
Yep.
We then have a tax plan, which includes state tax filings, business tax filings, compliance reminders. That renews at $19.99, just under $2,000 per year. So that's recurring revenue.
Got it.
Our highest ticket plan is $3,000 per year. That includes a dedicated human bookkeeper as well. So those are all true recurring revenue lines. Now, we have this bucket of revenue, which we call recurring revenue. And here's how I define it as. It's revenue, which technically doesn't renew on a subscription, but it's highly predictable. So I'll give an example. For every 100 companies that form with doola, a certain percentage of them are going to open a bank account with our partner bank. Our partner bank gives us a kickback.
Okay.
Very predictable. Every single month, 100 companies form, 20 go to the bank. We get a $300 kickback, just like that $6,000, very predictable.
I see.
Another 10 will actually do an expedited EIN for $300. That's another $3,000. Every month, as long as we're doing 100 companies, it's eerily predictable how those revenue streams come in. Actually, they will scale as a percentage of growth too. So a lot of people say, hey, if it's not true recurring revenue, it doesn't matter. And, ARR versus ARR, annualized run rate versus your annual recurring revenue. But I believe that these recurring revenue streams, they help us get to profitability faster. And ultimately, if we can solve problems for customers with multiple touch points, we're building a relationship with them. So we think both of those revenue streams are important. Obviously, we want long-term recurring value, so people are sticking with us. It's why we have analytics and bookkeeping. But there might be ancillary services that require these one-off filings, which no one wants to do. We'll solve those for you too.
Yeah. Yeah. And so the start, to your point, this, I think you guys call it the starter, right? And I would expect if they're starting their business on the platform, they're probably, it's a higher percent chance that they're going to take on these other options that you guys have as well, assuming you guys do a good job, of course. But I'm assuming you also have the clients who don't do the starter package, but maybe come in on the one of the other packages. Is that accurate, or would you say all of it's really like if you don't capture them up front, you're not really going to capture them downstream?
You're totally correct. We do see that of businesses that start with us, about 20 to 40% will actually, at time of purchase, attach to our bookkeeping and tax plans.
Oh, wow. Awesome.
So people up front, like, hey, I know I need these things. That's the value prop of coming to us versus having 5 vendors for 5 different things.
Yeah.
We also, though, are able to onboard customers post-formation. From a business perspective, that's big because there are about 4 to 5 million new businesses formed each year in the U.S. versus there's 30 million plus existing sole props in the U.S. Larger market. Right. A lot of those folks have maybe even felt the pain of bookkeeping or not filing taxes. So our TAM 6Xs or 7Xs, however you want to slice it, by going after existing businesses too. Those businesses as well, typically, and there's some sobering stats about businesses. Most businesses die, I think it's in the first 5 years, 55% of businesses die. We see, very similarly to LegalZoom's S1s or public filings, within the first year, 30 to 40% of new businesses organically churn. It's not because your service is bad, it's because starting a business is freaking hard. So we see those stats too. You're doing God's work if you can change that, which is what you're doing, is how do you make it more likely that someone finds product market fit? There isn't a formula for that. That's more the mindset and the market, the product, and the team. But ultimately, we believe that if we can make it easier to get the business started and help founders spend less time on the back office, we increase the odds that they can actually survive.
So was part of the thesis, let's make getting going a low barrier to entry, low cost, kind of appealing offer, and our margin can come more downstream in the cycle, so to capture them kind of upfront. So I would expect from a competition standpoint, are you guys seeing this race to the bottom of everybody must have this concept then, right? How are you navigating that?
Formation, I used to work at Dropbox.
Okay.
And at Dropbox, there was a time when storage wasn't a commodity, right? You can offer cloud storage and you can actually charge a decent price for it.
Yep.
Then Google and Microsoft came in and offer a terabyte for free or a terabyte for $1. So you can't really charge as much for the storage. It's a race to the bottom. Eventually, you have to give away the storage and add other value. That's how I view formation. It quite literally is a race to the bottom where companies will give it away for free. Company formation. So we don't lose money on formation, on the registered agent, on the address. Our margins are actually close to 60% plus, depending on the state. So it's not a loss leader. We make money on it, but our higher margin offerings, 80% plus, bookkeeping, taxes, software offerings like analytics, those get way closer to 90% plus margins. So that is our goal of, hey, we'll get you in the door with this formation offering, and it's an incredible experience. And as a team, we say 15 minutes of goodwill at formation can give you 15 years of goodwill post-formation. And if you wow someone up front, you build that equity, that value with them. So our goal is to continue to add to the box. The box today is formation, bookkeeping, taxes, analytics. We can continue to add to the box with higher margin, stickier offerings. And that's where we're going to make more of our profit down the line.
And percentage-wise, I think you mentioned it, but sorry, say it again. What percent are you seeing of the ones that do the starter end up taking on your next offering and then end up actually doing the bookkeeping?
About 20 to 40%.
20, 40, okay. And then these other, what's this next layer of additional ancillary offerings that you guys are thinking? What comes to mind when you?
I'll give one example.
Yeah.
E-commerce businesses, they have to, if you live in the US, there's this concept of physical nexus versus economic nexus.
Okay.
This is established by, in the US, if you physically live in a state or if you have a warehouse, you have physical nexus, which means you then have to register for sales tax and then pay sales tax on an ongoing basis. There's also economic nexus, which is typically, depends on the state, if you pass $100,000 in sales in a given year or over 200 transactions, you then have to file for sales tax and then pay ongoing sales tax. A lot of sellers have no clue how to navigate this. It's a massive pain to actually do the filing. So this was an example of, we heard, because we had more e-commerce businesses coming to us, they had way more questions about sales tax than bookkeeping or business taxes. So we realized, okay, at time of formation, we have an opportunity to very seamlessly, if you have physical nexus, we'll file your sales tax registration. And then if you are also reselling products, when you buy your first order from a wholesaler, you typically would have to pay sales tax there. But if you're reselling, you can get a reseller certificate. So you don't pay sales tax on that purchase. Instead, you just charge your customers when you sell through Shopify. So that's an example of an ancillary service, which isn't a core recurring revenue service. But we heard loud and clear from e-commerce businesses, it was friction from them getting up and then actually scaling to.
Yep. And right now, I think you guys service how many customers?
Over 10,000 on over 175 countries, 6 continents, no one from Antarctica yet. If you know someone from there, you got to tell me.
We'll get you there. And on the bookkeeping side, so $3,000 a year, is that, I have to imagine though, an e-com company that is doing, $500,000 in sales versus one that's doing $10 million in sales, the complexity is gonna vary. So how do you price in the scale of the business and kind of the different complexities?
Right now, we're nice. As you scale, we have software. So quite literally, we can tag 10x the number of transactions automatically once we know what you're doing. The complexity does increase. So for now, our sweet spot, our brand's doing about 1 to 10 million.
Okay.
We can support you if you're bigger, but truthfully, at that point, complexity will increase. So if I fast forward 5 years, we probably will have different tiers for brands that have hit a different level of scale. The goal is, though, we can support you from 6 figures to 7 figures to 8 figures plus. Now, if you become the next Liquid Death, you should fire us. Congratulations. You'll probably take your full team in-house, and you'll be our biggest case study or success story.
Yeah.
Maybe a harsh truth, though, is most people don't become liquid death, and that's completely okay.
Yeah.
If you build a brand that does 5 or 6 figures per month, let alone 7, that's massive for most people. And I actually believe that's a massive underserved and forgotten about segment of the economy. The YC-backed, venture-backed companies get all the press and the publicity, but most of the world is not raising venture capital or starting a C Corp. They're bootstrapped or they're a solopreneur. Candidly, I didn't know what bootstrap meant when I lived in San Francisco. Every day on my commute to work, I would pass Uber, Twitter, take a right on Second, LinkedIn, then right on Brandon. Dropbox was next to Pinterest and Airbnb. I didn't know what an LLC was. I thought the only way to start a business, and this might sound silly, is you need to form a C Corp. You need to raise millions of money.
Yeah.
Now, there's nothing wrong with that. Those companies are category defining, create massive value to society, but that's not the only path to starting a business. So now I know more of, okay, there's this thing called bootstrapping. You can be profitable from day zero. And that's most of the world, and that's who we're actually serving. We're not built for doola. We can say that candidly. Doola is not built for doola. Doola is built for that person selling T-shirts on Amazon, or they're building maybe a roll-up of Amazon FBA brands. Who knows?
And so I know you're at Dropbox for a couple years, right? You're on the product team, right? What's like the biggest takeaway you had from Dropbox that you've been implementing into doola? Is it a tactical strategy? Is it a mindset thing? What was the biggest thing that you're kind of taking into this?
When I joined Dropbox, they had this rotational program called the DRP program, Dropbox rotational program, where they quite literally said this is for non-technical undergrads who want to come work in tech. Dream come true. Typically, to break into tech, you need to be a software engineer, especially as an undergrad, because the truth is you don't know anything. So the company's saying, I'm going to invest in you and teach you. I joined and I didn't know anything. We were all hungry. We were learning. I learned product management from scratch on my first team. Then I learned SQL and analytics from scratch. And after that first year, you can then start to add some value. I was doing retention data science, then eventually a PM on the growth team. So the biggest thing I realized and learned, because I used to say, like, why doesn't Dropbox do more of this? Just get these really hungry young people, train them up and coach them. They killed the program after our year. And the reason why I now finally realize is that companies aren't, this is going to sound harsh, they're not charities or universities. At a startup, you need people who can come in and from day zero move the needle, because time's your biggest, time's the thing that equates all of us, the billionaire and the baby. But that's the biggest thing I realized is that you have to invest in people. I think ultimately, if someone isn't delivering output, it's a motivation issue or a training or capability issue. One of the two things. We at Dropbox, I had tons of motivation, but we knew nothing. And at a startup now, I've just realized that we can and we will get to a point. I'd love to have an intern program because we can have the luxury to invest on a longer term view. But right now, being way more focused on, from myself to leadership to new hires we make, can this person come in? Is it the right person in the right seat? If so, amazing. If not, we're not quite there yet. So that was an eye-opener, which finally clicked for me as a company where we're not quite yet at the point where we can have a full intern program because it's a disservice to everyone, the company, our investors, the interns, and most importantly, our customers.
Yep. So interesting. Okay, so I understand the revenue structure. Take us through the other side of this, the cost structure of it, right? So you have a staff, right? You're now at 8-figure plus revenue. Now starting to turn profitability. What's been your approach on the cost structure? How do you kind of think of and focus on turning a profit, the importance of it, and so on? And then how do you manage your cost structure today?
The first thing is, as a team, we have this slogan which we are aligned on. I took this from our investors' conversations, but it helps us really understand here's our goal, so everything follows from there. It's non-linear, profitable growth. So let me break down what each of those means. Profitable growth means it's not just growth at all costs. Growth at all costs is let's crank the top line, we'll worry about paybacks later, we'll acquire the customer. It costs $2 to acquire the customer, they pay us $1, but we'll figure it out down the line. That's not what we do. We're also not just going after pure profits. If so, we would slash our internal R&D, maybe offshore a lot of our hiring needs, et cetera, but we're not going pure profits. That's not our goal too. So the profitable growth, the balance there is, we look for in any acquisition channel immediate payback. And we have to do that because we go after SMBs. SMBs churn at incredibly high rates. our business just will not scale unless we can acquire a customer and make the money back. After that, accounting for churn, anything's gravy after that. Upsells, cross-sells, etc. So that's the profitable growth part. The non-linear part is we're here, we want to go after 100 million, we want to reach 1 billion founders, which means if we put $1 in or put one input in, we need to be getting more than one out, non-linear. So we think of growth channels. I'll give you a couple examples. If we create content once. This recording, I love doing things like this because create it once, replicate infinitely. It's the original software. And the cost to create this is either the time we are spending right now, or it's the cost on your team of the video editors or the content writers. So content to me is a non-linear channel where even if it takes 100 hours of watch time to get one conversion, that's a funnel. And you can go to 200 hours and the quality increases. Another example is we have a very juicy affiliate partnership program. Juicy in the sense of we give 50% uncapped commissions, meaning someone comes and gets our $3,000 plan, a partner is going to make $1,500 in cash. That's a really juicy commission. And the beauty here is that customer, we get 3,000, we're paying out 1,500, immediate 2x payback. Non-linear channel, it compounds too because that influencer, the video they post is only going to compound over time. We have the relationship with them. We can start to do more videos. That influencer also is not going to talk about our partners. Non-linear channel. So non-linear profitable growth then ties into, okay, where are we making investments that we think are going to fall into those channels? Or if we have a channel, like Google Ads, for example, where we put in $1 and get $1 out, we'll keep it. We won't shut it off. That's a bit silly if it's doing that. And then from a cost structure underneath, I truly believe, I've seen this from customers, I've seen this from the team, talent is everywhere, opportunity is not. We have a global team. Now, I do think, this might be an entire different podcast, there is value to in-person work, and I think it maybe depends on the type of role, but our philosophy is we have bookkeepers, CPAs, analysts, we have functions all over the world, and candidly, depending on cost of living structures in certain areas, that allows for, I won't call it cost arbitrage, because that kind of implicitly implies you're skimping on talent, but we haven't seen that. We want to hold a high bar on talent too. So I'll give you just a tactical, concrete example here. If you hire a bookkeeper in New York City, simply from cost of living standards, and we're not going to ask anyone to work for free, you're paying significantly more than hiring a bookkeeper in Bangalore, India. And we have seen you can get the same talent in both places. That instantly allows for higher margins on bookkeeping, for example.
Right. So, okay, a couple elements of this. One, on the actual acquisition of your customer base, I actually was thinking about this when you mentioned the paid side. How, of these customers that you're getting right now, how much are you, like, you're paying out a hefty referral incentive, which is, I mean, I'm sure if anyone's listening and is like, oh, I have like a bunch of e-com companies I talk to, they're like, oh, that sounds really cool. But 50 sounds really aggressive. So how, I guess, are you just assuming that it doesn't make up too much of your revenue, that it doesn't come from that? Or you actually don't mind if the volume from those affiliate relationships continue to scale because you're happy to pay that amount? You can justify it.
Absolutely. I mean, to break it down a little further, let's say someone pays $3,000 for that business in a box all-in-one plan. We're giving out a 50% commission, so the partner's getting $1,500. Now, from the remaining $1,500, we obviously have potentially a commission that goes to the sales team, and then our cost to serve internally. The bookkeeping team, the AWS bills, we're still making money overall, and we own the customer. So we're actually, again, we're not losing money with those payouts. We actually have thought about this. We could get more aggressive with the 50% payout and still make money. But we're okay with doing that because ultimately, again, it's a non-linear channel, and we are really incentivizing our partners versus, for example, to flip this another way, Google Ads, you can scale companies very quickly with paid, but once we pay to Google, it disappears. And you're getting no compounding value from that. Every month you're just putting money in and hopefully you're getting some back there. So we're okay because we're building the YouTube SEO, which is the second largest search engine in the world. We're building brand equity and brand value too, which is hard to price but actually has value too. And we're building this network or nodes of affiliate partners who are promoting doola all over the world.
And how, so of the revenue you guys are seeing, what do you know what percent's coming organically versus paid versus affiliate?
I'll give you the split. It's eerily it's about a third in each bucket. So the first third is paid.
Okay.
Google, and the reason why this works is someone comes to Google, very intent-based, right? If someone's on TikTok or Instagram Reels, they're there for entertainment most likely. So you're forcing someone to stop their scroll and then decide, should I level up my company with bookkeeping and tax, which is possible, but you're competing with girls in bikinis, bodybuilders, and dancing dogs.
Yeah.
Versus someone who goes to Google and types in best bookkeeping solution for Shopify.
Yeah.
So intent-based. They probably have a cup of coffee or a Huel caffeine next to them. They're like, I'm going to go figure this out.
Yeah.
Boom. They'll come there and find us. That's about a third of our acquisition. The next third is partnerships. So that could be, for example, let's say someone is teaching you, I'm going to teach you how to start a dropshipping business. Here's how you find your product. Here's how you start creating your TikTok UGC ads. Oh yeah, and you need an LLC for liability protection. Go to Doola. We're embedded right in there. We're not integrated, we're embedded. It's both.
Got it.
And other examples this could be if you need a business bank account, you need an EIN number. So for example, we partner with a bank called Mercury. In their onboarding flow, if you don't have an EIN, there's a little button that says need an EIN. Doola can help you go do it. So it's maybe an onboarding integration, course integrations, community integrations, content integrations. That's another third of our acquisition. The final third is my favorite. I'm obsessed with this. Every single week in our all hands, I bring up any example of this. It's direct or word of mouth.
Okay.
And the truth is founders know founders.
Yeah.
So that is the most powerful form of marketing. It's not TikTok. It's not influencer marketing. It's word of mouth, which kind of is influencer, but they're promoted.
Yeah.
If a customer has loved your experience enough to tell a friend, you're doing something special there. So we see about a third of our acquisition is direct, meaning I heard from a friend or I saw on this forum that someone was posting, and that should scale as the company grows as well. So those are the three buckets. If I had to choose which ones I would want, if I had to stack rank them, give me all the word of mouth, 7 days a week, twice on Sunday. The next one I would say is partnerships, because you can grow together.
Yep.
I'm okay with paid. Again, I'm not anti-paid if you can put $1 in, at least get $1 back, but I don't like how there's no compounding value there. Ultimately, I want to build acquisition channels where I can say, this thing's working for me when I'm not working. With Google, it's like you got to keep feeding the beast to get things out. With partnerships, a video that we worked on a year ago is just trickling in, compounding views.
Right.
With word of mouth, that customer who loves us is out there right now at a coffee shop talking about Doola. It's working for us when we're not working.
Yeah. Okay, that's fascinating. Okay, so I'm gonna go back to the cost side then. Obviously, a part of the cost is investing in acquiring customers and so on and so forth. But yeah, take us through the rest of it. How else are you looking at and breaking down the cost structure?
Our largest cost is people.
Yeah.
Given where we are right now.
Yeah.
I think outside of that, we do have potential fixed costs in terms of some state filings. It's like there's some costs that we bear there. Like for example, there's a thing called a registered agent, which has a minor fee. But overall, with our business model, a lot of our software, from a percentage base of our overall costs, isn't that major. It's mostly the people that we're investing in right now, and a lot of the investments too, again, are in future R&D.
Yeah.
So we have actually, if I think of our company, there's these three buckets. There's the R&D, which is building out, it's our engineering team, product and design team, building out things like analytics.
What percent of your staff is in there?
About a quarter.
Okay.
About a quarter in the R&D side. Then we also have, I actually believe, I saw this years ago and it's been imprinted in my mind, eventually every tech company has to become a media company and go directly to their customer. It's like, this is another thing I think of all the time, is a lot of people think of Red Bull and say, oh yeah, they sell energy drinks. I don't think that's true. I think they're a media company that happens to sell energy drinks, and they do tons of other things too. I actually want Doola to be, we're a media company that helps people learn about entrepreneurship, and we happen to do entity formation. So we actually have, I think of it as we're building this media arm within our company. Our marketing team is about another quarter of the company.
Oh, wow.
That's content writers, that's video editors, that's marketing engineers.
Oh, you're dumping a lot into that.
And that to me is a muscle where, again, we're creating content, which is zero CAC, fixed cost being the team, of course.
Yeah.
And you put out content once it replicates infinitely. Then we have what I would call the remainder of the company is what I would call support functions, but they're critical. So it's split in two. I would say customer success and operations is an extension of our product. So I don't think of it as just pure support. It's customer success is, after someone purchases, that human touch which we think is important. The way I view scaling that business is I say to our tax team, our bookkeepers, and operations, you are Tony Stark. But Tony Stark is nothing without the Iron Man suit. We're going to build the Iron Man suit for you. Our bookkeepers today can do 50 clients. 2 years from now, you'll do 500 because you can put the Iron Man suit on and you're Tony Stark.
Yeah.
And then the final quarter is maybe more of the pure G&A functions, finance, executive assistants across the company to provide leverage in other areas too.
Yeah. Interesting. Okay. And All right, so kind of broken out into these different quarters. One of the other things coming to my mind is you guys as you're creating these LLCs, your data is extensive now. The information that you have on a lot of these businesses. What's your plan, and how are you planning to kind of leverage this like information and data on all these businesses?
Really good intuition there.
Yeah.
The data, I think, is the most valuable thing.
Yeah.
And the reason why, it's right, you can have data on anything, but what do you do with it?
Yeah.
Here's the beauty. When the first Shopify business started with us, yes, we know this is the best state to form in, and we know that, okay, you want cash modified accounting or accrual accounting, okay? And yes, we know that because you're a multiple member LLC, you need to do a 1065 return, you'll have K1s, you can put them on your personal 1040. When the 1,000th Shopify business starts with us, we now know, because they have their books integrated with us, we have tax data, and we have seen the lifespan of what businesses have done. So there's qualitative now and quantitative. We know what type of metrics do people typically see? Yeah. What are good ROAS ratios, net margin ratios? So we can now get to this really exciting point where analytics for one customer can be informed by the other 999. Benchmarking, forecasts, here are what the most successful companies do. Here are benchmarks, or here are things that, hey, for example, did you know that this many companies actually use this Shopify expense as a write-off? We can automatically flag that for you in your bookkeeping as well. So with focus, that data set becomes even more powerful. Again, we can give you the business in a box if you're a marketing consultant, and that data will still be helpful, right? You can slice and dice, but as the number of these e-commerce businesses comes in, that data set and the forecasting becomes even more powerful.
It's funny, one of the things that I always ask people, and I'm always interested in, is on the KPI side, like what are and obviously the same question, but the way I think about it is, what are the guiding light KPIs that a company has? Why are those the critical ones that they're looking at? And I'm always curious to hear, as they're explaining it, like, are they actually the right KPIs? Are they going to be missing something with it? And so when I think of the data side, you guys have all this information on these companies. You also see which companies are doing the best, which ones aren't, and so on and so forth. And then you can kind of analyze, like, where are the elements of their business that they're performing extremely well, and what are they not? And you can use that to almost inform and help these other companies. So, well, my question to you would be, for Doola, what are the guiding light data points from a business standpoint that you're using to dictate how Doola specifically is doing?
Our top line metric, we repeat this every week in our all hands, is our annual recurring revenue.
Okay.
So that's the subscription, starter, total compliance, business in a box. And then we also do look at the overall cash coming in. So that's the annualized run rate, because that includes the redash recurring revenue too. So those are our top line two metrics which we look at. The primary metric is really the recurring revenue, because we know if you can build something that people are willing to continue to pay you for, most value there long term. Healthiest, stickiest, highest value type of revenue.
Totally.
From there, the next thing we look at is, how are we then getting that revenue? So we have a marketing scorecard where we can see by week, by month, by channel, how we're doing in each channel. And then that's broken up into inputs of, okay, top of funnel clicks, or how many people are coming, into our onboarding flow. So how many people are getting started, how many people are actually checking out. The other double click in there which we look at is, because the starter plan is $300, the business in a box is $3,000, way more valuable. Same customer, same consultation, same questions. The $3,000 customer, the meme is, right, they wire immediately and they don't bother you for 2 years. The starter plan's asking you every 5 seconds for an update. We kind of see that.
Yeah.
So the goal is what we call the total compliance adoption rate. What percentage of our weekly plans are buying the higher ticket plans? We monitor that closely, and we also look from a sales perspective, what does that rate look like too? Those are the key top of funnel rates. Yep. And then on the other side, now that we've delivered the product, we track very closely the delivery. So how long does it take for a new company to form on average? How many days to get your EIN, which is required to get your bank account? And then truly on the product side, we're now able to track with tools like bookkeeping and analytics, how often are people actually using the offering too. So from that perspective, that covers to us, hey, all the way from top of funnel into how people are actually onboarding and using the offering. Then even more downstream, what we're able to see is, okay, depending on the segment or depending on the plan, what does churn look like long term? I do think that it's going to be very hard to influence or change that 20 to 40% churn rate organically from businesses starting. But I do think that there's ways that for these existing businesses, by providing better forecasting, predictive analytics, you can slightly increase or bend the curve up a bit at the end in terms of retention there. So those are overall the highest metrics, and something which we're actively working on. And I'll candidly share this because we don't have it now, is we have all the numbers and data across many different places, but having just a clean, crisp scorecard with 10 to 15 charts that I can look at, call it an exec summary, call it like your key KPI dashboard. We're working towards that too, to like get a real pulse on the business.
Yeah, something you can wake up every day, check it, and pulse yourself. Yeah.
And actually, our new bookkeeping and analytics plan is called Pulse for that reason. It's so that you can keep a heartbeat of your business. The more graphic version of this is, if your heart rate flatlines, you're dead. Same for a business. If your business flatlines, you don't know your metrics, you're also dead. Right. So you don't want to let your business die. You need a pulse on your metrics, check your business's financial heartbeat.
So, all right. So you have the top of the funnel data points. Get that job. The customer is sold. Now you're measuring post sale. What's your actual utilization, or what's the efficiency of? They bought this thing. Now they actually want to see it come to fruition. So your team's, delivery, essentially of the actual service and the actual product. And then you have kind of the recurring elements as well. What about how are you guys measuring on the R&D side, the logistics, the operation, the OpEx, how are you really keeping a pulse on all of those things?
Our head of finance tracks this. Okay. The way we put a plan towards this is, in the end of last year, we put together an annual operating plan, which we presented to the board. And this is our forecast for what type of revenue growth we expect to see this year and the cost needed to sustain that. So our goals, again, were nonlinear profitable growth, meaning our goal is to double, and our goal is also to do it while hitting and maintaining cash flow profitability, which means you need these nonlinear channels. Sure. So now that we have those benchmarks, it's tracked on a monthly basis. So every month we can see, okay, how much revenue actually came in? Were there assumptions that were off in terms of, did churn spike, or did we actually get a higher percentage of redash recurring revenue? And then on a monthly basis, we're able to see, okay, we're on track or we're a little below track there. So technically, a lot of those metrics we can calculate and see in real time, but monthly is when we're doing that reflection of, hey, this is how we performed versus plan. And obviously on a weekly basis, every single week in our leadership sync, for example, we're posting key KPIs from each department. So the goal is we can catch things. If revenue comes in slower, okay, we're probably going to be lower end of month. Or, hey, this new campaign's working really well, we're probably going to have more cash coming in end of month.
Yeah. And what are you guys doing to have these priorities disseminated throughout the, entire company, from the entry-level person to your executive team? Do you feel that it's, you have a really robust system? I mean, you said you're building out the something you're actively working on for the company overall, but so maybe the answer is it's a work in progress, but how certain do you feel that all of your staff is understands the key objectives and is focused on the key objectives?
I read something recently which made me realize I need to be even more repetitive. Only when you get sick and tired of saying something is when everyone else actually hears it. Yeah. So every week in our all hands, which we call our Roomba, I repeat, I have a slide for here's our vision, here's our goal in terms of revenue goals, and here's our ideal customer profile. I repeat it every single week. I should probably ask this as a quiz, hey, put a quiz out. What is our vision? What is our primary goal? But I do feel pretty confident we're putting the message out there. I think the way that we want to then disseminate that through the company is we use objectives and key results. Goal being, here are the company objectives, here are departments, and it cascades down with the opportunity for cross-department collaboration too.
What are you seeing that other, where do you feel on the data point side that other people aren't, or maybe just the outside looking in, what do they not focus enough on that as the internal operator you would call out as this is really important? Whether it's an investor, whether it's an outside person looking at this type of business, that they don't value enough?
Self-reported customer attribution. Here's why. About 6 months ago, I decided to start emailing every new customer who starts with us. Hey, personal intro. Hey, it's Arjun. Thank you so much for choosing us. Can you just tell us how you found us? And if you have any feedback, you can let me know. Thanks. Plain text email right from me. People respond to that and does a couple things. One, they're like, holy crap, this doesn't happen in other companies. It's this thing, do things which don't scale. I think it's maybe the most important thing, though. I'm building a relationship with customers. It's that special thing that wows people. The second thing, though, is people will actually tell you how they heard about you. Now, here's the thing. They actually might tell you something which matches what first touch attribution says, but we actually sometimes see they say something different, which is important because that is to them what made the decision, or that made the biggest impact in their decision to use doola. So that actually helps us understand, okay, technically first touch attribution might say Google, but the person saying this blog post was incredible. Okay, multi-touch attribution, which for us is critical. The third thing though is this to me has been so huge in actually finding new growth channels, because someone might say, oh, I heard about you from this community. And I'm like, wait, I didn't know the community knows about us. I'll go reach out to the community and say, hey, let's set up an official partnership. So that to me, that non-trackable or self-reported customer attribution, I don't think that enough companies do it. I wish we started doing it earlier. Now we're actually adding into our onboarding flows a way to collect this more in a more automated fashion. I'm still not going to stop emailing customers. But the final thing I'll say is I've chatted with a few folks in partnerships or in influencer marketing, and something that they've seen in industry and we've seen too is that, let's say from influencer marketing, where typically someone puts a YouTube video out, hey, use my link, use my discount code, and come use doola. We've actually seen that oftentimes people won't always click the link. They might just go to the website. They might forget to use the code. They might be on their phone. They might switch to desktop so the cross-platform tracking doesn't happen. We've seen a 50% lift or increase in the amount of attributions if you tack on self-reported. So as an example, let's say your influencer marketing program says each month there's 100 attributions tied to it. If you truly tie in the self-reported attribution, you're talking 150.
Wow.
Really meaningful, but that data point alone, we were able to start to see that from asking customers. And that's yet another example of how it builds a really cool bond with customers. So do things which don't scale. It allows you to actually understand how customers are finding you, and it allows you to better attribute what's actually working.
Yeah. Wow, that's fascinating. What would you, so if you were looking at, if you're looking at competitors, other SaaS products maybe broadly, what are the, I don't know, maybe what are the things that you're seeing others doing that is really impressive or interesting to you? Maybe it is specifically a potential competitor, but yeah, is there anything that jumps out where you're like, man, we're not doing this yet? Like, we should be doing this more.
The biggest one, which impresses me, is the focus. It could be focus on the customer they're going after, focus on a couple channels which really work well, or focus in terms of the product that they're building out. Now, I think there's a couple new pieces of nuances to all of this. I do think in this day and age, there might have been a time a few years ago when you can build a true point SaaS solution, like a single solution in the workflow, and just fully focus on that and scale. I think in this day and age, though, because it's easier to spin up products, you need to actually be able to go multi-product faster and build more of a diagonal solution where we're going to be really good at this thing, but we offer these other things which aren't as good. But customers are expecting, I want the convenience of everything in one place. I think there's some SaaS overload, there's tool fatigue where I don't want 15-point solutions. I'm actually okay with a 90% solution for 80% of the cost. Or even more extreme, like a 90% of the cost, 80% solution. I'm okay with that. So that's one thing where when I see other companies going diagonal or being really clear, and this is exactly the customer we want to go after, I think it's impressive because it's so hard. I think focus is, everyone talks about focus, but I put it into this bucket of unteachable truths where you think you're focused and you realize, no, I'm not. And, I don't know, maybe Steve Jobs is the best at focus, where literally like there's the only one thing we're doing. And then something which I'm really trying to force is, I used to always think, this was something I learned, like you have a lot of people, so we can do 4 things in parallel. Now I'm like, let's force ourselves to do things in sequence. Even if we can do multiple things, what do we actually think is the most important thing? And typically that's the only thing you should do. I'm saying this as if we're doing it, but I'm really trying to, from an essentialism perspective, what's the one thing? Literally, that's probably the only thing you should do. And I think other companies that do that, whether it's their brand marketing, their customer acquisition, or the product, incredibly impressive. And those companies usually do pretty well.
I mean, look, I think it's one of the biggest difficulties of like, when you start a business, it's a little bit easier to be focused. Once you start to see some success, it actually becomes more difficult because you have more cash flow, you have more staff, and so on and so forth. But probably the difference between the good leaders and I think the great, one of them is how you actually balance these, new opportunities, shiny objects versus like ruthless focus and discipline on it. And I think it's something that everybody can probably improve and continue to improve on. But for people out there that are like at that phase and constantly juggling, I hear it all the time, they're juggling like you almost get to this paralysis level of like, there's all these different things you want to and can do. And oftentimes the best thing is just like, look at the number one thing that's the biggest priority and just dial in, like double down, focus there. I actually liked in the beginning, you were like, we're leaning into this e-com space, where in my head, I was kind of like, yeah, but a lot of the elements are pretty similar for these other industries, right? It might be easy to get there, but it's just another thing that's going to add another variable to it, right? And distract you and your team and so on and so forth.
So true. The analogy which made this click for me is when you are starting business, relationship, project, I liken it to you're climbing the first summit. You're like at the bottom and all you can see is this first mountain.
Yeah.
So you start to climb and then two things happen. You reach the top of that first mountain and you realize it's a false summit. Yeah. You just at this, and then you realize actually there's 10 other summits you can climb. Those you didn't know those existed until you climb the first thing. That's like shiny objects, 100%. New options you can do. So I think the best leaders are the most focused people. They have this sobering focus where they're like, yeah, there's 10 things I can do, but I know that that's the one mountain that matters.
Yeah.
And whether that's real focus on, hey, these are my objectives and key results, so I'm going to print them out, put them on my laptop, and that's the only thing I look at. The second thing, though, is once you start climbing the mountain, you realize the mountain wasn't the goal. I just like climbing mountains. And I think that's why a lot of people, they can't stop being entrepreneurs. Is like, it's not about climbing or reaching the summit. It's like, nope, I just like climbing mountains.
Yeah,
I want to keep doing that.
It's just the experience of it. Yeah. Shifting gears a little, what aspect, or is there an aspect of the business that's that keeps you up at night from not from an excitement standpoint, but from like a nervousness standpoint, whether it's like, I don't know, the AI disrupting your industry drastically or another competitor. Is there anything that like always has you just a little concerned?
We are seeing signs of nonlinear growth channels, but the thing which I really want to have extremely strong conviction on is, let's say, I think the goal with any business is you want it to be a money printing machine.
Yeah.
So like the first thing is like you don't have a business until someone pays you. Yeah. Like a lot of people, like I say, you don't need to start an LLC to start a business. Get someone to pay you. Yeah. Even if it's through your Venmo, we can get you a business bank account. We'll probably account for that so the IRS doesn't audit you. But business is when someone pays you. Revenue's exchanged. Ideally for less than it costs to acquire the customer. Otherwise, you don't have a business. You have lose money to get someone. Once that's the case, though, the thing which I think any business wants is how can I put something in and get way more out?
Yeah.
Like a money printing machine, especially for, I think, a VC-backed company, where how can I get to a point where if we had 10, 20, 50, 100 million, you can deploy it and with extremely high confidence know the machine's built. We're not only going to get at least $1 back, but even more. So the thing here, which maybe this doesn't answer directly, but it keeps me excited, but also the thing I really want to see is, can we see just one or two channels where we have that level of confidence? That's the thing where, again, we're seeing the signs, but I want to get to the point where there's way more conviction. Then that gets really exciting because then you can start to fuel either external capital in faster, or you actually as a business know we don't have to maintain a strict profitability line because we know based on our paybacks and investment cycles, we can run things a bit more aggressively knowing the payback will come back too. So that to me is the single biggest thing. And I think this is also, just to have some perspective, our business, even if we continue to linearly grow, in 50 years, we'll be doing close to 100 million. Like just linear growth, which, hey, that's actually pretty insane. We actually had some investors who at post-YC, they passed on us because they said, there's an outcome where this business does like tens of millions of revenue. It's not a venture-backable outcome though. Like for a venture-backed fund, they need 100 million because they own 10% and that returns the fund. Now I actually get what that means. Like venture is an asset class. You're investing for a return over a certain period. So a 50 years to 100 million actually isn't a venture-backable return or outcome. But it's just perspective like, okay, the linear outcome takes us there. So what's the point of trying to grow faster? I think the point of growing faster is growth is the ultimate goal for anything. You can also reach more people. And I think as a company, we want to have a bigger impact too. So how do we go from the linear to non-linear? What are the channels, which I like into like you're digging for oil. Once you find it, let's build the oil rigs. I want to get high conviction. It's time to hire people to build the rigs, put in steel orders, like go scout the ocean out, take a boat out there. I see the sign, like the camera's getting more focused, but that to me is the biggest thing, which keeps me up at night in a good way. And then soon, and this is another change which I had to make, which no one actually taught me this, and now I see it in books. It's this transition of when you're a founder, you're an IC when you're a founder, and your value is measured in terms of output and quality of the work you do, like numbers, and then obviously there's a quality metric there. You're digging for oil. then all of a sudden, once the product starts to work or the offering works, you're actually measured, you're a CEO now, you're a manager, and you're actually measured on the quality of decisions you make, not just individual output. So your output could be, did I unblock a leader or give someone perspective on the company? You can then go teach the rest of their team too. So that's a transition. I'm like, holy crap, I wish someone just like hit me in the head and explained that in this day and age right now for the company, leverage isn't how many emails I can send. It might be actually, emails I can send to a partner. It actually might be using that time to hire the head of partnerships who can build an entire oil rig structure around that too.
Yeah.
So that keeps me up at night too. Like, crap, I need to make that transition. Am I focusing on the truest high leverage thing in the company? And I think the way I'm trying to be better at that is weekly reflection, monthly reflection, and quarterly reflection, which comes from, we have a weekly leadership sync, on a monthly basis, just doing a look at our numbers, and then quarterly doing objectives and key results.
Yeah, definitely. You mentioned, which I actually want to come back to it, you had some investors that passed because of XYZ reason. What were the other reasons that you saw? What were the other challenges you ran into on the raising side, and what are, maybe even on a go forward basis, what are the challenges you think you'll run into that investors just like don't love about the business or the industry?
Biggest challenge, and now it's turned into a learning, is in Y Combinator. And a lot of people ask, do you think YC is worth it? My blunt answer is, I would rather have 93% of something than 100% of nothing. So YC takes 7%, it's a lot of equity, but first time founder, I didn't know what I didn't know. And I take the help too. Also, hate it or love it, YC has a brand. Like, we like to say, don't judge books by their cover. People judge books by their cover. Shocker. Having the YC brand helps a ton. Customers, future investors, and talent as well. In YC though, the thing which they do a good job of is in demo day, they line up investors to come invest in your company. So I held on to this mindset for too long of, you don't need to build relationships with investors. Just like demo day will be there. When we're ready to raise, like, we'll just be ready and things will be there. Shocker, in life, relationships actually matter. So again, this sounds silly, but now my philosophy is I follow this rule called the 1 in 30, where each week, 30 minutes spent updating existing investors. So like just a little weekly update or talking to one of our existing investors, and then 1 hour or at least one meeting with a new investor. And my goal there is, even if I don't know if that investor is going to invest, investors are smart. And I can talk to them, ask them like, hey, what do you think about our go-to-market? And then build the relationship so that when the time comes, if and when we are raising, they've known me for 3 months or 3 quarters. We've built a relationship. And now it's more just about, hey, like, let's really together think, are there any metrics or things that we don't like, or any big blockers to the company we don't think we can turn around? To answer the second part of your question, what don't people like about our business? The single biggest thing is acquisition. I think most companies die not because they can't build the product, but can you repeatedly acquire customers? And then, especially at a Series B stage, the investor's thinking, okay, not only can the company get to tens of millions, but is there a path to 100 million? And will they hit a wall or get stuck too? So really building belief that there are acquisition channels that the company has that are, N of 1 versus 1 of N, and that they can continue to acquire customers and there's a path to expanding the product suite. I think for us, look, what we're building isn't rocket science. Formation has existed since LLC has existed since the 1960s in Wyoming. There's 2 certainties in life, death and taxes. We do taxes. That's never going to go away. And then bookkeeping. Most people don't know what bookkeeping is, but you need it for tax prep. Analytics, you can only manage what you can't measure. It's like those things on their own aren't rocket science, and we can continue to add things into the box which have existed. I think we can innovate though from bundling and providing, there's more data and insights from the combination of those things. And I think you can always innovate on acquisition. So I think of, hey, how can we have product differentiation, innovation in terms of acquisition? And then my goal is the NFL owns a day of the week. They own Sunday. Airbnb and Uber are verbs. Let's Uber there. Let's Airbnb there. My goal is doola becomes a verb. You doola it. Let's doola it. And that means start and scale your e-commerce business.
Yeah, I've seen you post all about the dueling it out there, and I love the just relentless drive on it. It's good. It's exciting to see. I'm curious with the trend, the landscape has changed over the past couple years. How do you, what's your mindset and approach to AI right now? And B, in a space where tech innovates and develops so quick, how do you stay at the forefront and how do you stay ahead of it?
AI is fantastic as long as it solves a problem for our customers. That's ultimately the most important thing is if we're solving a problem for our customers, they will pay us and stick with us.
Yeah.
Our customers, they're okay with us using AI to more efficiently tag or categorize their transactions or to make our team efficient. But they want to talk to someone to understand things. So we've just seen loud and clear. People, it's a scary process. They view it as building a relationship with doola to trust us to manage their company. So what that means is, okay, if we believe that human touch or consultation is important, rather than try to automate away the human, how can we make it human in the loop? So I'll give an example here. Our tax preparers or CPAs, they've now worked with hundreds of these e-commerce businesses, so we know the most common types of write-offs. We know, hey, for sales tax, there could be economic or physical nexus. There's these types of filings required. Rather than trying to use AI to remove the person and just like say, hey, customer, go read this thing, how can we make the CPA more efficient so that behind the scenes, they're able to put together a custom report, which is obviously based on other insights, based on the customer. Can you take a transcript in from the consultation and customize it that way? So again, it comes back to, I actually really believe it is AI for doola is how do you build the Iron Man suit? That's our philosophy, is use internal AI to automate and make bookkeeping more efficient for our bookkeepers, make tax recommendations more efficient for our CPAs, make the formation process faster. From the media company perspective, AI hasn't gotten to a point where I think it can end-to-end, with taste and understanding your vision, put out a perfect 60-second video short, but it can definitely help you write a script.
Yeah.
It can definitely recommend B-roll. It can definitely maybe automate parts of the uploading process.
Yeah.
So same way, for our content team, how can we make 2 video editors as powerful as 20?
Yeah.
How can we make 1 social media manager as powerful as 2? And that, I think, is where, for doola, we see the value as AI versus having a pure AI interface for customers. One example of that interface which might work, though, is you have customer data. How can you interface with doola and using AI say, hey, my business is doing $1 million. Give me the top tips to get to 2 million next year. And then automatically using our data set, AI can actually provide that, and there's a bit more of a self-serve interaction module there.
Yeah. So do you feel pretty firm that for these new businesses, specifically, the customers you're going after, that the kind of full automation side of it is just an extreme that isn't really where it's going to go to? You think that human touch is going to maintain its value and is going to maintain its focus?
Human touch upfront with occasional human check-ins. However, I think you can have just pure software like the AI analytics interaction, which provides value beyond that. But for our business, I just truly believe that your business is your baby. It's an emotional thing. People care about it too. And we do, and we've seen it's a differentiator to be able to talk to someone. Now, the same thing applies, though. I actually don't think for our sales team going forward, we'll have to linearly hire more sales reps. I think we will get better at, through content and through our self-serve onboarding flow, increase the amount of companies that start self-serve and shift the amount of sales energy towards the higher ticket customers versus someone just starting a business. They're like, okay, I actually don't really need to talk to someone too. But again, rather than get rid of the human, it's human in the loop. And ultimately, I do think that AI won't replace someone's job, or AI won't kill our company, but someone using AI will replace your job, or another company using AI will beat us. So we're going to have to use AI. Just my fundamental belief is internally to make our team more efficient, Iron Man suit, versus completely replacing all people and just having a pure tech-based AI interface.
I see it. I get it, and I can appreciate that perspective. What about when you look at the SaaS landscape as a whole? What's your outlook in POV, and when you're looking, I don't know, 5 years down the road, where do you see SaaS sort of developing into differently than where it's at today?
I really do think the term agent is used, where an AI for a specific workflow can handle multiple tasks end to end. I really do think that we will see more bundling. I call it these diagonal solutions, but I think that's what an agent is doing, is rather than, again, having 5-point solutions that you have to navigate, the agent is working across the stack there. Now, the agent could be a company, but I do really think that companies will have to go multi-product faster, and I really do think that the expectation will come from customers that, hey, this agent or this tool can do multiple things for me. So I guess my one-word answer is bundling. I think there will be more bundling coming forward, and I think that not that you can't build a single point solution, but I think you'll have to go multi-product faster.
Yeah. For e-com business owners today wanting to start an e-com business and so on out there, do you have a core, I don't know, 1, 2, 3, 4, 5 tips, hit points that you would give to people in the e-com space that you don't share? First, doula it.
First, doula it. Three biggest tips I would say. From a financial perspective, separate personal and business. A lot of people, again, you can start with your Venmos and having a personal bank account, and don't let that be the blocker to actually taking action. But the earlier you can separate personal and business, the better. It opens up business banking possibilities, business credit. So get a business bank account, quite literally, and just run things through there. That's the very first thing. To do that, you need an LLC. What I would say is, look, if you're serious about actually scaling your business, you're going to need an LLC at some point. Yep. You get liability protection. You also go from being a freelancer to being a business. Same person. You're one person, but just social proof and the way you view yourself, I think it makes a big difference too. The other thing I would say is a lot of people, and I think this is just part of shifting the hat as you go from first sale to scale, is you hold on too long to things like sending invoices manually on your own, or checking your own books, or even going to the state's website to do filings. And I saw this graphic which blew up in my mind on this. It was a graphic showing when you're working with an executive assistant, what are $10 tasks versus $100 tasks versus 1,000 versus 10,000. So $10,000 task could be going to fly to go meet a new partner that's going to send in 5 leads per month or 10 leads per month. It could be talking to an investor who could potentially invest millions in your company. It could be going on a podcast to share the story of doula, and that's going to get insane distribution. Things that only you uniquely can do with asymmetric upside. That's how I copy it. $10 tasks are things like you actually could, if you just paused, record yourself doing it, and someone else could do the task. $10 meaning potentially a VA in the Philippines or somewhere else. I think the hardest switch is realizing you need to actually, to scale your business, shift out of $10 tasks and shift into the 10,000. So that's the biggest thing too, I'd say, is you can't shift prematurely. You can't just expect someone to come and do it, but more regularly auditing, even when you're starting. Hey, I've gotten my first sale. There's now some money coming in, even if you haven't raised funds. How can I start to get executive assistant support or a personal assistant support to start taking the $10 tasks off my plate so I can shift into the higher leverage tasks? Something I waited way too long to do. And I've thought about this. I really do believe in extreme ownership.
Yeah.
I really believe there's absolutely nothing in the company that I won't do. Literally nothing. Like if an office cleaner isn't there, I'll take out the trash. Like I'll respond to customers. But if you lean into that too hard, it's a disservice to the entire company, because what you really need to do is figure out a solution for those things. And the final thing here, which was hard for me to understand, but it's true, there are things which you love doing, your zone of genius, and things you don't like doing. The thing you don't like doing, for example, it could be responding to customer success messages. Let's use an example. There is someone else out there in the world who loves that. They eat, sleep, breathe, wake up, and love it. Like whatever it is, whether it's recruiting or finance, there is someone out there who actually loves it. And I just didn't grok that. Where I was like, wait a second, because I don't like it, no one else will, so let me just keep doing it. Now I'm like, nope, there is someone out there. It's not a what issue, it's a who issue. You need to go find that person and stay in your zone of genius. So I'm saying this because I wish I did this earlier, and I'm trying to be way more cognizant about it, flipping it to, yes, it's good to have extreme ownership, but you're doing a disservice to everyone if you're trying to be the head chef and the busboy and the waiter and you're trying to order the food. You're holding back the entire company. You're the bottleneck if you're doing that.
100%. Oftentimes, actually, founders don't realize that they are, to your point, they are actually the biggest bottleneck. And it's painful to see sometimes. It's harsh realization at times as well.
I actually think that this is the most humbling thing about companies, is that they're a reflection of you as the founder.
Oh, yeah.
If you're doing too much as a company, it's because you're doing too much.
Yeah.
If your task list has 10 things, probably everyone else does too. And I think that extreme ownership, you are the bottleneck for everything. There's either you're not communicating clearly enough, or the priorities aren't set, or a combination of all of that too. So it's humbling, but I think it's why people say companies are the ultimate growth vehicle. 4-year college degree in 4 months or 4 weeks or 4 hours.
Dude, this has been fire. I appreciate all this. I got some last closing questions for you. First, what has been what is the most challenging operational hurdle that you guys are working, that either you have had to work through or you are still working through today?
When we started the company, and I think this is why you really just need to take action, our back end through our seed round was Airtable. And it was Airtable. When we started, I started an Airtable. When companies would come through, company name, and I made these a drop-down single select field for docs received, formation docs sent, EIN signing, getting bank account. And I just manually tracked that process. Airtable was our backend. Like, you don't need that was a no-code solution. We started to add webhooks in. There was a no-code website, but that took us through our seed round.
Wow.
That also creates issues, though, because now in hindsight, holy crap, we could have used HubSpot as that CRM from day zero. Or maybe we could have just used Shopify. Like, actually, technically, we're not like D2C ecom, but Shopify manages so many of these things too automatically. So I think our biggest operational issue, which we have now significantly improved, is what the core backend infrastructure looks like. And oftentimes, that doesn't matter when you're starting. So like, we're here today, I can talk about, we're at this point, that's an issue, but we spent significant time rebuilding the back end so that it's in a position to scale. Even something as simple as, this is going to sound silly, having an infrastructure that allows a new business to form with you or an existing business to onboard with you. You might be thinking like, yeah, what's the difference? They can just pay a full multi-quarter initiative and project, but we now have that capability for that asymmetric upside. So that was a huge operational and engineering challenge that we did solve. Going forward, I think the single biggest thing for us, and it's a work in progress, is how can you take these workflows that span across taxes, bookkeeping, and formation and make them really cohesive and atomize them so you can use as much automation as possible. It's like, before you build the full Iron Man suit, we can't wait 10 years to build the suit. We have to build like the arm first. And then we have to build goggles. And then eventually you have the full suit. So like, a lot of people say, I like this analogy of building a company. You can take 4 years to build the Ferrari, or start with a skateboard. You then turn that into a bike. It then turns into an RV, and then turns it into a car. That's how I view product development. In the same way for the suit or operational. Iron Man's the goal, but like, let's start doing it piece by piece.
How much of your product development and just that whole workflow was is influenced by the Dropbox experience and kind of their systems and processes and so on and way of thinking?
I had this huge wake-up call when we started. At Dropbox, bigger company. Anytime you'd work on a new initiative, we had these things called P0s, then P1s, then P2s, then P3s, then P4s. I think the P stands for project. I don't even know what it stands for, but this huge, robust process of, here's the initial proposal, get sign off from people, the next step, the next step, the next step, and then the P4 is like, cool, we're ready to execute. So when we were early doola, I was doing these kind of like long planning documents, when the truth is, you need to just talk in a stand-up with a few people and say, let's go build it and see what happens. So that was one thing to unlearn, which you don't need as much planning, because you need to just take action, and you're not looking for a 10% incremental gain. You need a 10x, which is likely a new feature, just putting something out there. However, that skill is now becoming more useful now, because the team has grown. We're actually, ounce of preparation is worth a pound of post-preparation, or pound of the cure. So that specifically didn't help me at the earlier stages, but now it's like, okay, I need to bring a bit of it back, where a really crisp document can actually provide a ton of clarity to the entire company, and really leaning into that more. I do think overall, though, that what I did at Dropbox was a lot of looking at analytics and looking through our cancel flows. Why are people canceling? This really good mix of qualitative data with analytical data or quantitative data. And I think that has obviously helped here, where I'm able to understand both sides of that puzzle or equation.
Yeah, it seems like it could help with, to your point of unlearning, right? Like there's phases of a business, and some things that you do later stage is not what you do early stage, but you kind of figured out the early stage, and now, maybe it does allow you, where the stage that your business is at, you can still continue to be a good founder CEO and not be like, oh, this is like past my scale. Because now you can almost bring in these elements of how your brain does know how to think, prior experiences, and you can say, this is the stage where we actually need to be a little bit more robust, thoughtful about some of these execution practices.
100%. I think that one of the biggest things that I truly think stops people from, like, who makes it or is successful versus not, this is going to sound so wooey, but I actually think it's the truth, is those people don't have these false limiting beliefs. I call it savage clarity, where I met some of these people, and they're just like, it's insane how clear their goals are, which can change because the summits change, but it's just so precise. And I think it comes from the focus and them actually just taking the time to think, and then also not having these limiting beliefs. So here is one limiting belief I realized with myself, is that the transition is tough. You've never done it before, but no one's ever done it before too. But I realized, and this is like you can call this like a limiting belief breaking quote, which you can do for anything, is I don't have an inability issue. It's an inexperience issue. And like when I just say that to myself, it's like so clear. So you know how you break inexperience? You devour books on the topic. You immerse yourself in podcasts. You talk to people who've done the thing, who've climbed up the ice wall before you have, and you front load, right? There's quantity has a quality of its own. How can I just have more of these meetings and practice it too? But just even that alone is like, look, everyone has gone through the stage of being a first-time founder into the transition. You're not alone. You're not special, shocker. Yeah. The way you make that transition is the same with anything in life, where you start with your piano scales, they suck. Next thing you know, you're doing the scales looking up. Next thing you know, you're singing the piano. Yeah. That happens over time, and actually being bad at something is the first sign that you're on the path to success.
Yeah. I love it. Man, you're so well spoken. This is great. Good stuff. All right, last few things for you. Is there anything else you're passionate about that you want to share with the listeners or just with me?
Something that has kept me sane the last couple of years, and it's something I tell myself, which really reminds me that it's, I would argue, as important, is sharpen your body to sharpen your mind. Again, it doesn't have to mean you have to be an Olympic athlete or something too, but just find something where I really think that, and we've seen this historically, some of the greatest thinkers, they would have these walks they would do, like religious walks, whether it's around Stanford's campus or through the forest or through the woods. And I really do think when the body moves, the brain solves. So having some sort of movement where, for me, the 20 minutes when I exercise, you get endorphins, but I'm a better person the other 23 hours of the day. And the truth is, it's going to be a long-term process and grind. I don't think life's a marathon. It's more of a series of sprints, but it's still going to be marathon-type distances. So I'm really into the intersection of those two things. I've always been into, I have like an Oura Ring competitor here, and I've tried different continuous glucose monitoring and stuff in the past too. But I do think before you can help anyone else, you have to help yourself and invest in yourself too. The most important asset is you, your health, your body, your mind, your mindset. So I'm really into that, and I really enjoy learning from other people who found things that work for them. I also love that because I think it's a never-ending game. You're just competing with yourself and chipping away. Some people say like, oh, what's the point? Like, what's the point in trying to optimize this thing or that thing? And I think that's missing the point of, hey, you're just trying to improve. And like anyone trying to improve, whether it's your business or your health or relationship, kudos to you. Like I think the growth mindset is so rare to see. I think naturally it attracts the type of people who want to work in businesses or on businesses and early businesses too. But I'm really into that. And I really enjoy learning from other people who have cool things they've learned, whether it's hacks or just habits they have that really help them, again, sharpen body to sharpen mind.
Yeah. I see you're active on it online, and I couldn't. It's honestly a whole separate pod that we could do on the importance of it and everything. So I could not agree more, and I appreciate you emphasizing that. Over the next few quarters, what is there one thing you are most fired up about?
I remember after we had raised our seed round, and the goal was to get to 1 million in ARR. Post the seed round, we were at maybe 1 to 200K. I remember being at home in Pennsylvania, which is where my parents used to live, middle of nowhere. You go there, you can actually hear birds chirping. And I was walking the dogs down the driveway, which is a mile long, like really, really rural. And I remember just thinking, how the hell are you, like, this is impossible. I have zero clue how we're going to get to 1 million. Full thoughts like this is stupid, they were all right, you're not going to do it. And then the experiment that changed everything, which we did the next January, is we said, let's introduce this higher ticket plan for $300 per month with taxes. Like offer a monthly plan and incorporate this thing, boom. That year we went from 250 to 1.6.
Oh.
So I think the thing is, and this is the learning I've had, is you're always one something away. You're one piece of content away. You're one funnel away. You're one influencer partnership away. Not to just really, overnight win a lottery ticket, but see the inflection point. So to answer, that was a big preface. The thing I'm most excited about the next few quarters is, similarly now, it's like you go into the year thinking, how are we going to do this? Like when you're doubling or when you're trying to do something nonlinear, what you're actually doing is you're trying to do in 1 year everything you've done in the history of the business. That's what doubling is. Right? So we've been around 4 years. We're saying we want to double this year. That means in 1 year, we want to do what we've done in 4 years. And then next year, the goal is going to be to do that again. So just thinking about that's kind of wild. But the thing that I'm most excited about is I actually think that the camera's been blurry, but it's slightly getting into more focus now. And that's always fun. So to me here, as long as we are focused on the things that are working, the camera is getting more focused. And I have to be really, really, really clear. We have to just hit this year's goals. We're not talking about 5-year goals, this year goal. Next December, I can walk down that driveway and stress about how are we going to get to the next thing, but that's a good place to be in. So the camera's getting more focused. Maybe I'll go back to Pennsylvania to walk down that driveway to ponder. But really, if we just focus, the camera will get more focused, and I'm excited about that.
Yeah, very exciting. Very exciting. One of the last ones for you. You don't have kids, do you? No kids. What is the most important principle, in your opinion, to teach either your current kids, or if you don't want kids, that you think is just to teach another human?
Being normal is overrated. I would like to have kids one day, and I'd want to really make this clear to them of when you grow up, we all want to fit in. It's wired in our DNA from the hunter-gatherer days, where if you weren't part of the tribe or sitting, where the dogs were protecting, you get eaten by a hyena, or a neighboring tribe would come kill you, which is why we had to fit in and wanted to fit in.
Yeah.
That adaptation used to serve us then. It doesn't serve us now. I mean, don't get me wrong. You still want to fit in with different tribes, but in school when you're growing up, the whole goal is to fit in, to conform, to go along with the pack. Everything's very syllabized and professors, and there's grades and goals. But now I've completely flipped my perspective on this, where being normal is overrated. I actually say normal's a dishwasher setting. Like it really is. You don't really want to be normal. You want to be yourself, and whatever that pans out to. Whether, again, I don't believe that everyone needs to be an entrepreneur and break the nine. Like, no, there's many different paths to doing what you want to. But I think this principle of life's too short to not truly be who you are, and not being afraid to do that, which is so hard because we care what other people think. Again, it's wired into our psyche. But I would want to create an environment or be around people who are okay going after what they want, and share that with kid, or share that with an adult, share that with anyone, where it's okay not to be normal. I think that's actually a really good thing. You shouldn't be ashamed to sit in the front of the class. You shouldn't be ashamed to raise your hand and ask the question at a conference. You shouldn't be ashamed to try posting the thing, sharing a bit about yourself, even if none of it works, even if it is cringe. I actually think that cringe is a prerequisite to success in anything in life. And the wildest part is you think more about yourself than you think anyone else is. Like, how does my hair look? The person probably didn't notice it. They're probably thinking about dinner they're having later that night, or they forgot to drop off their laundry. So I would just say that normal's a dishwasher setting. Like, I would want my future kids, and I would want anyone to know with me, I really don't want to judge you for going after what you want. And I'd want to be supportive of whatever it is that motivates and drives you.
Yeah, leaning into the uniqueness that makes you you. Great concept, great principle. Man, this is fire. I want to shout out Hampton for we've actually never met each other. It's the first time that we've met in person, and this is flowing like we've known each other for a while. So shout out Hampton, great community to meet like-minded people. Where can people find you, follow along with your journey?
Doola.com, and on social, just Arjun Mahadevan on all social platforms. And thank you a ton for having me on. This was awesome conversation, and I'm excited to see what happens in the next few quarters.
Yeah, man. Cheers. This was great. Appreciate
Thanks, man.
you.
Appreciate it.